Welcome to Week 10. We're about to cover probably one of the most important parts of the market. I know everything you learned last week probably has your head spinning around a little bit, maybe feeling a little overwhelmed, but you're now starting to learn the different intricacies of the market beyond just finding the signals. So this week what we're going to do is go in and figure out where to place our stops once we're in the market. I think that's one of the hardest parts for traders, or the hardest thing to do for a trader, is once they get into trade, they don't know where to get out. They stay in for their losses and they get out of their winners. So we're going to spend a lot of time going over charts day by day, making executive decisions, and learning how and where to place your stops. Remember, in trading, we trade our belief systems. So every time you place a stop or every time you get in a trade, you are trading your belief system. So it's very important that you have a good basis and that you have a lot of different options to go with, and that you understand why you're using these options or why you're placing these stops and the reason that you're placing them. So let's go ahead and take a look and see what our goal is for the week. The goal is to learn the 4 different methods of placing stops, and then on Friday we're going to learn how to fill out this Profitunity trading partner. Let's go ahead and get started. So for day 1, the goal is to learn how to use the red and the green line stops for being in the market. The red and green line, you know, I'm referring to are of the Gator. The red line is the Gator's teeth, and the green line are the Gator's lips. By using the Gator, you will never be left out of any significant trend. And the Gator is used for many things beyond just allowing you to know what side of the market you want to be on. We also use it to place our stops. All stops that are used with the Gator will be placed as stop close onlys. First one we want to look at is the red line stop. The red line stop is the one you want to use when you feel like you are in a trend. This is the stop that is used to hang in there, to be in there long term. What you'll notice in the market is many times the market breathes. You're going to see the market pull down or go in one direction, and then it's going to pull back like it's taking in a breath. When that happens, most of the time the red line, if you're in a good trend, the red line will keep you in. Many times, and because it's stop close only, it will keep you in. Many times the market will rise up within the mouth of the Gator, as you see here, but it doesn't close beyond that. It closes below it. So the red line is a stop close only, and it's meant to keep you in a trend. Now notice we have none of the magic bullets present. Once you start seeing magic bullets present, you may want to change your stop. Here's another example. If you look here at the AO, look how it's increasing. We have no divergence, the AC is accelerating, and the Gator's mouth is wide open. This is where you want to be in. This is a great place to use the red line stop. Now you see the area circled. This is where you might consider changing because of the angle of the price bars against the angle of the Gator's mouth. You may want to move your stop up. We're also going to talk about some other options. But the Gator, notice here, I want you to notice that how long the Gator was asleep. Notice these saddle points. How long the AC and the AO were balanced at the 0 line. That's what we refer to as the saddle point. Almost every chart I've ever looked at, or every market I've ever seen, the longer the Gator slept, the more explosive the move was when he came out of his mouth. Now granted, there's a lot of whipsaws in there if you don't have a good technique to avoid that choppy area, but once it comes out of the mouth and you see the Gator open like this, usually it's quite a big trend. Nice move, someplace that you definitely want to be. Now here's a chart that I've split it up. You're going to use the red line and the green line stop. In the beginning of the trend, you notice that you had your alligator was asleep, you had a fractal up, and then you were in the market. Then the market goes up, and you see that, notice the area with the first circle that I have here. At this point, you didn't have any divergence. The market pulled back, and actually the price bars pulled down and closed below the green line, but they did not close below the red line. At this point, you've been real happy with the red line stop. Then here, notice you're starting to have some divergence. You see changes. The AC is changing. The AO has changed. This is a point when I'm probably going to take my red line stop, or I know I will always take my red line stop, and I'm going to move it to a green line, because I do not want to get caught. If I've been in this move and I have a lot of profit in, I don't want to turn a winning trade into a losing trade because I have not placed a stop in a good spot. Here's another chart. Using here, as you see, I've pointed out, using the red line would have kept you in. In that entire circled area, none of those bars ever closed below the red line. You had your fractal up at the beginning of the move, clearly outside of the gator's mouth. And notice these carrots. If you see the carrots on top, those are fractals. But with CQG, it does not mark all of the fractals. What you'll see there is the most recently completed fractal or fractals that have been hit. So if you notice a fractal has not been marked, that doesn't mean it's not a fractal. That just means it's not one of the things I have just mentioned. But you notice at the end where you have an arrow pointing to the end of the AO, you have divergence. Once you have divergence, you're going to want to change your stop from a red line and probably pull it down to a green line. You're going to want to start looking for your magic bullets. In this chart, we've got a green line stop. The first reason we started using the green line stop was the difference of the angles of the price bars compared to the gator's lips. If you look at that price bar angle straight up and look at the angle here. Those are very different angles. So if we placed a stop here at the green line, it would definitely be a loss. We're not comfortable with that. So what we've done is we've decided, at the red line, excuse me, the red line would have been a loss. It's not a comfortable distance between here and the market. So we have moved our stop up and placed it on the green line, stop close only. And in this move, this is where you exit out. It closed about one tick below the gator's lips, which is the green line. Now this is a 5-minute Dow chart. In a volatile market, you always want to watch what you've got as far as the indicators the market's showing you. If you've got magic bullets, if you've got squats, by magic bullets I'm referring to squats, which that is a 1-1 squat bar. If you have fractals, if you have a change in momentum, these are all things to look at. But in this particular case, what I want you to notice is the difference of the angles between the price bars and the gator's lips. You will always want to use at least a green line stop when you have that drastic of a move away from them. Now in this instance, you had your fractal, you're in the market. Notice I've pointed out measuring squats. You should know what they are by now. Last week you talked about some of the Elliott wave and different things that go on with the magic bullet, so you should know what that is. If you don't know what a measuring squat is, you need to go back and review. Here we've got circled a 3-3 squat. Here I have a 3-3 squat bar. Well, in that case, I probably want to tighten up my stop. I'm starting to see some things change in the market. So I've gone from a red line to a green line. You've had a change in momentum, and you've also had a change in acceleration in the histogram, so you want to pay attention to everything. These are all parts of the puzzle here, so don't ignore just one. Here's another example of a green line stop. 4 of our magic bullets are present, so we're going to pay closer attention to the market. We do not want to turn a winning trade into a loser. So you notice that you've come up through here, then we have, this is our exit bar. Where I have circled, though, you've got a squat area. If you were to pull volume up, you would see the amount of volume in that area. You've got a down fractal, you've got an up fractal, you've had a change in momentum, you have divergence, and a change in acceleration. So with all these things are signals pointing, or not signals, but let's say warning signs of the market saying, hey, pay attention, I may be about to turn around. And as you can see, it did. You see where the price bars went into the gator's mouth, and you can actually see where the gator's closing his mouth. That's where we do not want to be caught, in the gator's mouth. Okay, here's another scenario. We've got here, and also notice the measuring squats on the way down, and if you look at those, they're very close. If you start from the beginning of this trend, and you measure halfway through the measuring squat, and then go again to the immediate bottom, we're pretty close. So a lot of times we're not sure at the beginning if it's a measuring squat or it's the end of a trend, but you'll know the next 2 to 3 bars. So in this example, what I want you to notice is the double divergence you have on the AO. Look at your peaks. Okay, look at your price. You have a higher peak, a lower peak, and also a lower price. So you have divergence between price and between the AO. At that point, you have a couple different options. Now, I have 1 bar circled, which is your exit on the green line. Then look what happens. Look at this area. What happens to the alligator? So that green line stop close only was a very good place to be out. And also, if you notice, you had twin peak signals along here. Remember when I told you that you'll see a twin peak before you see across the line and a change of trend? Well, here's a very good example of that. Okay, and here's another example of a red line, green line stop. Either one. At the beginning of this trend, you would have probably wanted to use a red line stop. Notice that in this case you wouldn't have been stopped out, but the market pulled here. But here you would have been stopped out with a green line stop. But at this point we now have a double divergence right here. This is the point where I probably would have changed my red line stop, pulled it up to a green line stop, because I'm starting to see some changes in the market. We have fractals, we have squats, we have a double divergence. This is where you do not want to get caught. The market can really bounce the other direction. Remember, an A wave and a C wave in the wave 4 are impulsive waves. So when a third wave is complete, you may see a very quick bounce. So at this point where we're circled, this was where our green line stop stopped us out of the market. And this was a very nice move. This was the Dow Jones on a daily. But notice that the next bar, look where it closed before it bounced back up. So that would have been a rough ride if you'd have hung in there. But don't forget your magic bullets. Look at what the market is telling you. So that's the end of day 1. I know it's been a lot of information. You may want to go back and review day 1 a few times before you go on to day 2. Have a good evening. Make sure you're doing your morning pages, and keep in touch with us if you need anything. Okay, now we're back at week 10, day 2. Today we're going to look at how to use the 5 consecutive green or red bar stop. This is probably the stop that I use the most. I would say probably one of my most favorites. I don't have a problem with taking money off the table. I don't like giving it back to the market. The idea behind the 5-bar consecutive stop is that the market usually does not have more than 6 to 7 consecutive bars of the same color. We usually see the market pull back after a number of consecutive red or green bars. Remember, the momentum and acceleration determine the price bar's colors, which I'm referring to zones. There are times when we want to use a tight stop, especially in volatile markets. If you're trading a 5-minute S&P chart, you're going to want to use the 5 consecutive bar stop. I would say 95% of the time. So whenever we have 5 consecutive colored bars, we will place a trailing stop after the 5th bar is complete. We will continue to trail the stop up or down until the market takes us out. It does not matter what color the bars turn after you've had your 5 consecutive bars. We will continue to trail the stop until taken out. Let's go ahead and take a look at that on some charts now. First one we're going to look at is the Dow Jones on a 5-minute. And you can see I talk about the Dow a lot. I like to trade it. It's one of my favorites. So that's why sometimes in the office we don't have a lot of time, and hopping in here for about an hour is stress relief for me. So here I've noted using a trailing stop after the 5th red bar, you had been stopped out at the bar circled here. So we started counting from here. Now do remember, a blue bar is a squat bar, and you have to look underneath down at your AO and your AC to see if that's a red bar, because the squats overlay the colors, and that will be the same in super charts or TradeStation, even in Investor's Dream. Squats do take precedence. It's much easier for you to look at the AO and the AC than it is for you to figure out volume divided by range from the previous bar. So just keep that in mind. So we started our count. 1, 2, 3, 4, 5. Placed our first stop at the top of this bar. We then moved it down. Once the 6th bar was complete, we placed it at the top of the 5th. After the 7th bar was complete, we then moved our buy stop to 1 tick above this bar. After the 8th bar, the bottom bar here, was complete, we moved our buy stop, protective stop, 1 tick above the high of the 3rd bar. And then you see on the 9th bar this high, we then placed it here, at the high of this bar. And then this took that out. So we were stopped out at the very bottom of this move. Couldn't have been better placement. Most of the time, being stopped out with a 5-bar consecutive trailing stop is one of the most profitable places I have seen in the market. Most of the time it will save you, especially, like I said, in the volatile markets. If you want to be in and out, or you're a scared trader in the beginning and you want to protect your profit, you may use this. As you gain experience, you may decide to hang in there. Go with the green line, the red line. And also we're going to discuss later the first signal in the opposite direction. So let's go take a look at some more of the 5-bar consecutive stops. In this case, you'll see we're in. We start counting. I've marked a little line here on the bottom so you can see if you're having a hard time following it up. 1, 2, 3, 4, 5. You have 5 consecutive green bars. So we start here. 3, 4, 5. You've got number 1 is marked. It's our first trailing stop. Then we place a trailing stop at number 2, and you're stopped out here at the bar circled. And again, notice what happens. Pulls right down, goes into the gator's mouth. Now this is a stock chart. This is a daily stock chart actually, but it worked just as well here. This is actually a Pfizer chart. So right now, if we were looking at it today, it would be down in this area. It'd be interesting to see what happens. So we were looking at Pfizer. This was May 5th, I believe. So we'll see what happens in the future. 5-bar consecutive stop. Again, we have another market. This is going to be a natural gas chart on a 30-minute. Notice you start here with the consecutive bars, 2, 3, 4, and 5, and we're stopped out at the very next bar. Market goes sideways into a wave 4. So that was a good place to be. You could have hung in there, and if you'd have hung in there, your green line stopped, you would have been stopped out here. Now please don't take me wrong. There's many times that a green line stop or a red line stop are better than the 5-bar consecutive. Any stop you choose to place in the market is going to be an executive decision, always. Depends on your belief systems, depends on the situation, how long you've been in a trend, how much money you have, how much money your account has, how many drawdowns you can suffer. There's so many different influences on what you do. But remember, we're here to help you, and our goal is for you to learn how to trade best for you and how to be in tune with the market. Okay, so here we've got another 5-bar consecutive stop. This is a Canadian chart on a 30-minute, and we're going to follow it down. And here you noticed I put the saddle point. The AO and both the AC are very close to the 0 line. This point, you followed your trailing stop down, and you see where you're stopped out at the circled bar. So that's not a very bad place to be stopped out. And you can see the alligator is starting to change its formation. Instead of being wide open straight down, you're starting to see a turn here. I pay real close attention to the alligator, and you'll notice in time you'll start to be able to recognize its movements, the way it drastically changes or when it's starting to close up. At first it's going to be a little foreign to you, but that should get easier. We have another 5-bar consecutive stop. This is in the British pound on a daily chart. And you'll notice here's our fractals. You've come down 5 bars and you're exited on the very next one. Change in acceleration. Actually, this market pulled up right after this. I went back and looked at it. But this is how you're going to be using your 5-bar stop. I have one last chart on the 5-bar stop to show you. And in this one, this is a Microsoft. We have a stock chart. And notice the big gap, the gap up. Well, in a gap up like this, we definitely want to protect that. You had your first bar. Here's your fractal up. I know it's a little difficult to see, but I wanted you to see the overall look. This was the day you'd have been long, gapped against you. You'd have been in here. Next bar gapped up. And that was actually your 7th green bar. So they have a trailing stop here. We want to protect our profit. There's no reason if the market gives us that kind of profit that we should give it back. So now we're at the end of day 2. We've covered the 5-bar consecutive stop. We've covered the red line and green line stop close only. And remember, the 5-bar trailing stop is a stop. It's not a stop close only. And also keep in mind, as I said earlier, any stop you place is a psychological, or trading is a psychological adventure, I think. Every day is a new game. Every time you look at a chart, it is new. You're playing a new game, and when it's over, it's over. So make sure you're having fun while you're doing it. Try to do the best by yourself. Go with your belief systems and have fun with the Profitunity trading techniques. Today is day 3 of week 10, and the goal today is to understand the last exit technique and review all the exit signals. I just want to go over again, remember that the markets, every chart that you look at, every situation is going to be different. There are going to be times that you are not going to feel comfortable with your position, and if that's true, you need to get out. There are going to be times when you're going to have different magic bullets and different indicators in the market saying, hey, look at me, pay attention, I may be about to end a trend, I may be about to turn around, maybe the time for you to get out. So we have enough different options in our stops and our exits of the market that you should be able to get out and feel comfortable with them. What we're going to cover today is the first signal in the opposite direction. The time you're most likely going to use these, or the times you'll most use these, will be when you have your magic bullets. because you're going to want to get out. The first signal in the opposite direction basically says the first thing that changes, any kind of change. Now you know with the AC, we create a lot of signals. It's probably going to be the one signal that gets you out, that or the balance line. Maybe the twin peak. We're going to go through and look at examples of all of them. And here we go. First signal in the opposite direction, and this is on Harley-Davidson. This is a stock chart. Notice this long move. This was a beautiful move. One peak, two peak, three peaks. So you've got a divergence, you've got an AO cell, an AC cell, and a fractal. Here are the signals I've pointed out at these circled parts. Now the reason you've got a lot on the chart is that if I just show you that area, you're not going to really see what I'm talking about, the concept of this move up and how to protect your profit. So it may be a little hard to see. You'll be able to see it on your printout. It's going to be in the computorial, which you'll be able to view very clearly. So just notice here's your twin peak, here's an AC, and here's an AC cell. So between those three, the latest your exit should have been is at this point. This is the Alliance Corp Management, another stock chart we're going to take a look at. You see where your entry was. You stayed in throughout the move. If you had a red line stop, you'd have stayed in. Green line, you'd have been stopped out in this area. But notice your fractal up. You'd have been right back in. Look at the Gator's formation. The mouth was open. But at this point, notice your AO. From this point to this point, we have divergence. This is a twin peak cell signal. Remember, this peak is higher than this peak. Next bar is red. So there's a twin peak cell. You have an AC cell. And we also have a balance line cell. And you also have 6 consecutive green bars. So in this one scenario, we have 1, 2, 3, 4 reasons to sell, 4 other signals that would allow us to get out. So the market is giving you some warning, maybe a turnaround. And as you can see, what happened here, market pulled down. So if we'd got out in any of these positions where I'm circled, you'd have gotten out at the best possible spot for this move. Next situation, now this is a real different situation here. We had, I believe, 11 consecutive green bars in a row. You rarely ever see that. Here is your fractal up, Gator was open, you're in. Your first sell signal is here, generated by the AC. So you'd have been filled the next day. Also, if you'd used the 5 consecutive green bars and just followed it up, you'd have been stopped out the next day. So in either scenario here, it would have been the perfect place to get out. You're selling the high. Next situation, again, we're in a trend move. You've seen the gap here. We have a 3 of 3, a 5 of 3. We've got divergence. We've got a twin peaks. We've got an AC. And we have a 3-1 bullish divergent bar. Now you should know what a bullish divergent bar is by now. Bullish divergent bar means it's got a lower high, lower low, but it closed in its upper half. The buyers took charge. So after a move like this, the buyers take charge. You may want to have a closer stop. If you were at the red line, you certainly would have wanted to move it to at least the green line. Once you saw the change in the AC and the twin peaks, you may have decided at this point to get out. And your other option, of course, was your green line stop, which you'd have been out here at this green bar. Either way, and also, very important I've noted here, it's a 1-1 squat bar. If you have a 1-1 squat bar, what does the market tend to do? Think about it when you squat down. You're going to jump up. What did this market do? Straight up. So 1-1 bullish divergent squat bars are very important. You need to pay attention to those. Many times we will make an executive decision based solely upon that bar. So that is going to be the end of day 3 of week 10. As you're starting to figure out, you've got a lot of different options now. We've got green lines, we've got red lines, we've got the 5-bar consecutive stop, you've got the first signal in the opposite direction. So you trade your belief system, and you're going to trade the one that best suits you and best suits your comfort level. Make sure that you understand the reasons behind all of them. Make sure that you're going through Investor's Dream. It's a great place to practice these stops because you have all 3 options and see which one works better for you. But do remember, paper money is always different than money in the real markets. So I hope you have a great evening. Tomorrow we're going to get started and go over executive decisions. See you then. Welcome back. Week 10, day 4. We're going to sum everything up today. kind of make, hopefully you'll understand what we looked at the last few days this week and put it all together. So let's go ahead and take a look at our first slide. Executive decisions, and as I said, every stop really is an executive decision, but we're going to label these executive decisions and we're going to go through them. In this case, we've got divergence, we have a change in momentum, we have an extreme 3-3 squat bar. So we have 4 of the magic bullets in, don't we? This is a time when you need to pay attention. And notice how drastically at the bottom of this third wave, the market bounced up. Remember, an A wave is an impulsive wave. So here we see an A, B, and C is probably going to be higher than that. But what's important is that we got out here on the bottom. This is an important bar. You need to pay attention to it. You also had AC signals at this point and at this point. You may not have decided to take those, though, until you had the divergence in the market. And then you had, of course, the 3-3 squat bar. Now, the 3-3 squat bar was really in your favor, but it is a squat on the bottom. The next bar was a green bar came up. The next bar was a 3-1 squat bar. So needless to say, you should have been out by here. Green line, at the least conservative, you'd have had a green line. If you'd gone red line, it'd have been a little bit more dangerous at this point. You might have had a losing trade, depending on how many contracts you were in. So do keep that in mind. Stop close only closes wherever it closes at closing range, not at your price necessarily. Now in this chart, another example. We can see the market. This was probably wave 1 here. We had an ABC of 2. We've come down for 3. This is our largest peak on the oscillator. And we have divergence. Also, we have a twin peak buy signal at this bar. And you had an AC buy signal at this bar. So you had a couple different options of what to do. And you also would have been stopped out here at the green line. But both the AO and the AC would have worked well. So just keep in mind, I know I'm repeating myself a lot, but this is the most difficult part of trading for all traders that I talk with every day. They say, I can get in, but where do I get out? So be aware you have many different options. Here's another one. In this case, we had 9 consecutive red bars. You cannot ignore that. I cannot ignore that. With 9 consecutive red bars, I know the market is going to pull up. Usually it pulls up pretty drastically. And at this point, your trailing stop would have had you stopped out here, so you'd have bought the bottom. Not a bad place to be. Notice what happens here. Look at the alligator. We go into a sideways market. Now, many people are going to want to say, well, you had an up fractal here that would have been valid. Would you take that? Something that I stress very much at the tutorials, and I haven't talked about too much throughout the course, is that in wave 4s. Yes, you will have a fractal up in a wave 4, clearly. And what's going to happen after the bottom of a 3, you can have a 4, which is going to be an A, B, and a C. Those can be very profitable. I don't touch them on a daily basis. I'm only interested in trading those intraday. You have a lot less control on an A wave and a C wave. If you're on a daily bar, it may be hard for you to get in there and react to the market because you don't see the market until the end of the day. On an intraday basis, though, when you trade that A and C wave, the alligator is going to be wide open, and it's going to look like it's in a 3 wave. So just keep that in mind when the market starts doing this and you exit. Know after a third wave move and divergence, you're going to have a wave 4. If you take that first fractal, you're most likely going to have a loss unless you keep very tight stops. Here's another example. We had 11 consecutive green bars. This was our exit. Now we could have got right back in here at this fractal up, traded it, and we'd have been stopped out here with a green line. But we chose to get out at this point here. I chose that point. And you also had an AC sell as well as your 5 consecutive bar stop that would have gotten you out of this market. So I think you should be starting to see all the different choices that we have. Okay, I've labeled this chart the big picture. This is a July of '97 corn chart on a daily with daily bars. But what I want you to see is the big picture, and then we're going to break it down into this area and look at the smaller picture. Notice you started having divergence here, to here, to here, to here. And we finally ended up here at the end of wave 3. This is going into wave 4. Now we want to closely examine this area to show you all the different warning signals or the sell signals that were created, the buy signals, excuse me, that were created to give us a pre-warning to get out before wave 4 happened. We had all of our magic bullets here. We had change in momentum. We had squats on the bottom, we had fractals down, and we've got some more signals. Here's an AC signal. Here's a Twin Peaks signal. Here's the 7th peak, which means we had a 6-tuplet divergence, and this would have been the next buy signal if you'd ignored the ones previously. Now, you might have been stopped out here in this area if you hadn't paid attention, depending on the green line. But just notice that the market is giving you all the signals. All of your magic bullets are here. It's run out of momentum. Look how the market can't push anymore. All that steam, it has run out. It's at the bottom of a move, bottom of a wave 3. So be sure you pay attention to the magic bullets and know what they are and have a good understanding of how to find them and see them, putting them together. Now, that's something Investor's Dream will not do for you. It doesn't know that the market has divergence, or it's the end of a third wave, or there's an extreme squat bar, or there's a bullish divergent bar on the bottom. So these are the things that you're going to have to look at, get familiar with, and start learning about the market. If you don't, the market's going to teach you some very expensive lessons. I can almost promise you that. The last slide I want to look at that has the charts on it today are going to be this one. Notice this is a crude light chart. Gator was asleep. Your entry up here was your fractal. You followed it down. We've started to create, at this point we thought we had some divergence, didn't we? Until look what happened. This peak took it out. But up until here, before that peak happened, we had a Twin Peaks. We were stopped out in this area, and then we re-entered again here in this area. At that point we thought we were probably at a bottom of a 3. So we were out, we were happy. Then we see the market comes down again. So we re-enter, which is fine. We took profit from here, re-entered, went short. Now you had 5 consecutive red bars here, 5 consecutive red bars here, and you had a 1-1 extreme squat bar on the top, on the bottom. So between all these, you should have had an idea down here on the bottom, maybe time to get out. If you'd exited on the green line, it would have been here where this arrow is pointing. 5-bar consecutive stop would have had you out on this bar, and your 1-1 extreme bar would have also had you out on this next bar. And then notice what happened. We went into a big wave 4. Again, I'm not interested in trading that wave 4. I have just ridden this all the way down. I'm quite happy. This is the time, if you have been in a move that long, you know the market must correct. Take some time off. Go look at other markets. Maybe not trade it for a month. Come back to it. Don't give back all your profits. I see it happen all the time. And it's hard. You need to protect your profit if you have it. Learn to become a successful trader. Learn to listen to yourself. Learn to be in tune with the market. This is, like I said earlier, this is probably the most important part of trading. How do you exit a trade? When do you exit a trade? And feel free at any time to fax us, email us. If you're in the market, let us know. You take priority. We will stop what we're doing. Someone will answer you to help you while you're in the market. So this is the end of day 4 of week 10. Tomorrow we're going to go through and fill out the trading partner, which we're going to actually go find the signals on the screen, fill them in to be able to place orders for the next day. I hope you've learned a lot this week. You may need to review this tape over and over. Feel free. Have a great evening. See you tomorrow. Welcome to day 5 of week 10. Today we're going to cover the Profitunity trading partner. This is our way of keeping up with our trades, where our proposed trades are, our positions, and our stops. So far you've learned how to find all the signals. Now let's put it all together and put it down on paper. What you've got in your home study course from the Excel program is the Profitunity trading partner. And what we've done here is I've simply drawn it out on a larger scale so that we can go through day by day as if you're home doing this and filling out the trading partner. So that's what we want to take a look at today, is go through, pick out the numbers, find the signals, and place them in here. Now let's go take a look at some of these on a chart. Okay, so we're going to take a look at the world sugar on a daily chart. And this is Friday, the end of Friday's close to fill out for Monday. To find your orders Monday, you want to look at the end of Friday. That's very important. Okay, so let's go in, and first we see we have a fractal up and a fractal down. Remember, if we're not in the market, we want our first entry to be a fractal, and it needs to be outside the Gator's mouth, or if it's a buy, above the red line, and if it's a sell, below the red line. So we have a fractal up at 983, and remember, you must add 1 tick to the high, so you'd have a buy at 984, and you would have a sell at 943. So we'd be bracketing this market. We wouldn't care which way it went, simply bracketing the market, letting the market tell us which way to go. Now let's go ahead and write that in our trading partner. Okay, notice the way the trading partner is laid out. All your buys will be on this side, the mom will be in the middle, and then all your sells will be on the other side. So this should help you to keep it separate and make sure that you don't miss any signals when you're going through the markets. So we had our buy at 984. Okay, and we had our sell was at 944 minus a tick would make it 943. Now, the only other thing we need to do here is find out what the mom is. Remember, we go to the AC, we'll look at the bar. Is it above or below 0? Well, it's above 0, so it's an up arrow. But it's a red bar, so it's lower than the previous bar, so it's a down arrow. And that's all we have to do today. We're going to wait and let the market tell us what to do tomorrow. Okay, so here we are Monday, and our fractal down got hit, so we're now short. So we need to do a few things. We need to go through, see if we have any new signals, and we also need to place our stop. So the first thing I'm going to do is see if I have any signals. Well, we had an AO sell cross the line yesterday, but since we weren't already in the market, we won't take that. We come down to our AC and see we have 1, 2, 3. So we have an AC sell signal. We'll go to the low of the completed bar, and that low is at 910. So our AC sell signal will be at 909. Now we're also going to have another signal. Have you figured it out? It's going to be a zone add-on. And that comes off the close. Remember, that's not the high or low, it's off of the close. And you're going to add or subtract 1 tick from that. So let's go back to the trading partner and fill it in. Okay, so first of all, we're going to put parentheses around the fractal that has been hit. So we know we have taken a position. And we'll pull that down to the bottom where it says POS, and that does stand for positions. So we've got the 943, so when I look at my trading partner that I'm short at 943. The next thing I want to do now is fill in my signals. So I had a zone add-on at 920, red, zone add-ons. And we also said that we had an AC sell at the low of the bar, which would have been at 909. So we're going to go here to the AC sell column and fill in 909. Now the mom in this case, it's below 0, so you know that's a down arrow, and it's red, so you know you have another down arrow because it's lower than the previous day. So what I want to do here, there's a change from an up-down to a down-down. So I want to circle the arrow that's changed so that I know I'm aware that there's been a change in the market of the current acceleration. Now the next thing that we want to do is we're short. We have 2 sell signals in. Now we want to place our stop. So let's go back to the chart and find our stop. Okay, so let's take a look at this chart. Now, you see the alligator still a little intertwined with the red line and the green line. So what I want to do is come up here and get the price value for the moving average. We're going to use the red line here. And the price is 962. So from that we're going to add 1 tick for our stop. So that would put it at 963. Okay? So 963 is going to be our stop. Let's go back and put that into the trading partner. Okay, what we do with our stop is whatever side we are in the market we are in, we're short in this case, we'll go to the opposite side, the balance line, and that's where we'll put in our stop. So I'll go in here, and I know that I'm going to place my stop at 963. Now, this is a Gator stop, so it's a stop close only. Don't forget that. Now we want to make sure that we place our fractal buy-in at 984. If we were to be stopped out at the 963 and the market turns around and goes up, we want to be with it. So we're going to put back in our 984. And now we're going to go to the close of Tuesday to fill out for Wednesday. Okay, so the first thing we're going to take a look at is what happened with our orders from yesterday. We had a 909 AC sell that obviously didn't get hit. Let's see what happened. If you look at the AC, the acceleration is continuing down, but the low, we have a higher low, so what we really have is a blue light special. The market has given us a better sell price, so we're going to change our sell price of 909 and we're going to move it to 924, one tick below the low of that bar. Okay, so let's take a look at that on the chart. Okay, so the AC sell, we said we had it at 909, but now it's a blue light special, so we're moving it to 924. Also, the mom, we want to check out the mom, and the AC is below 0, so we have a down arrow, and it's a red bar again. So if it's a red bar, we know that has to be a down arrow as well. No changes from yesterday. We won't need to circle anything. Next thing we want to look at is we did have an order for a red add-on at 920 if it closed lower than 920, stop close only. Well, notice that it did not close lower than 920. Let's go back to the chart for a moment. Okay, you notice this close is higher than the previous day's close, so we did not have an add-on. But we do have an order for an add-on tomorrow. And the close of that day's bar is 930. So we're going to go back to our chart, and we're going to fill in 929. Okay, so we have a 929 zone add-on sell for tomorrow if the market closes lower than 929. Now, I think we should go back to the chart and see if we're missing anything else and get our stop. Okay, we don't have an AO sell. We said we had an AC blue light special. What about a balance line? Base -1. We have a balance line sell. So the low of that bar was 910. So now for the balance line column, we're going to have a sell in at 909. Okay, so we're coming to the balance line column, sell side. We're going to place our balance line sell in at 909. So the only thing that we're missing now is our stop. We want to go back, get our stop from the Gator, depending on the market. Let's see how many red bars we have. Remember, there's a lot of different market conditions that decide or help us decide where we're going to place our stops. Okay, in this particular case, we only have 3 red bars, and we're still going to stick with using the Gator. So 962 was where it was yesterday, so we had placed it at 963, and it's actually at the same place today as well. So we're going to stay with the same stop, and remember, it's a stop close only. So let's go back to our trading partner and fill that in. Okay, we're going to the balance line buy side. That's where we're going to place our stop since we're short, and we're going in at 963. We also want to place our fractal back in because it's still the most current up fractal and is valid. So we've covered 3 days so far. Is it starting to come together for you? It's not real difficult, but we've formatted this particular Excel program so it should be easy for you and you shouldn't be missing any of the signals. Let's go back and take a look at Thursday. Okay, so now we're looking at the close of Wednesday to fill out for Thursday. Let's see what we have here. We had an order in for a sell at 924. We had a balance line at 909. And we also had a zone add-on. Looks like we got filled in all 3 of our positions. So let's see what we have for today. We'll go back to the trading partner in just a moment and circle those to let you know that we have taken those positions. But let's look and see if we have any new add-ons for today. We can't have a balance line because we have a new low. We cannot have an AO because we haven't had a change in color. We've already been hit on our AC yesterday or today, so we don't have a new AC. So the only new order that I can see right now would be a zone add-on because we do have a red bar and it is closed lower. So we've added on from yesterday and now we have another potential signal for tomorrow. And that closes at 901. So let's go to the chart and fill it out. Okay, I know I have one for tomorrow at 900 even. We took a position on the reds. We also took another position on the balance line. And we also got filled on the AC sell. So now I will fill this in at the bottom so I know what positions I have and where I was filled. And I didn't get filled at 929, did I? I got filled at 901. Okay, so now I'm in 4 positions, 4 contracts. I want to look at the mom for today. which we had at red below 0, and it's red. Again, I say it's red, so it's lower than the previous. So we have 2 down, down arrows again. Now, the only other signal we had generated was the zone add-on, and we're still carrying our fractal down because the market has not created a closer one for us, and that is valid. So here we are back to our stops again. At this point, I'm going to move my stop to a green line instead of the red line. The market's starting to pull away. Now, if tomorrow is another red bar, that will give me 5 consecutive red bars. I will then place a trailing stop on this trade. Okay, so here I am at moving average 3, which is the alligator's lips, the green line, and that value is at 960. So I'm going to go back to my trading partner and fill it in 961 stop close only. Okay, so here we are, balance line. This is also we're using for our stops. So we've got 961 stop close only. And some of you may want to write stop close only in there. It may help you in the beginning to get a difference, because when you're using the Gator, it's going to be stop close only, but when you're using a 5-bar consecutive or the first signal in the opposite direction, it's going to be just a stop. So you'll need to figure out what works best for you. Let's take a look at Thursday for Friday now. Okay, so here we are. It is a close of Thursday for Friday. What we see, it's a blue bar, but remember, the squats overlay the zone. So if we come down to the AO and the AC, that is a red bar. So we know we have 5 consecutive red bars. But let's go ahead and look for signals first. We had only one potential order in, and that was stop close only at 900. Well, this bar closed at 910, so we did not add on here. The low of this bar is 898, and the low of this bar is 900, so we can't have a balance line either. Come down to the AO, we haven't had a change in color. Same with the AC, we haven't had a change in color. Now this is good though, because the market is going in our direction. Sometimes it seems a little boring. We may not have 4, 5, 3 signals every day. We may just have 1, but that's okay. As long as the market's going in your direction and we're making money, we don't care. So now what we want to do is place our stop. And since we said earlier we had 1, 2, 3, 4, this is our 5th consecutive red bar. So what we're going to want to do is place a trailing stop, and that trailing stop will be 1 tick above the high of the bar. So let's go on to the trading partner now and fill that in. Okay, so we're going to come into our trading partner, we're going to fill out our stop, and it's going to be at the high, 1 tick above the high, so it's going to be at 929. We also still have our fractal to fill in. Now, one thing I want to mention, we didn't continue, or we didn't get a zone add-on price for today because we've had 5 consecutive red bars. After the 5th bar, we don't want to add on any more in that manner as far as zones. We will take other signals, but not any more zone signals. So, let's fill in the mom, and we'll be done. Again, we're below 0, and it's a red bar, so it's lower than the previous bar, so we have down, down arrows. So as you can see, now we have gone through and filled out our trading partner for a week. You've got Monday, Tuesday, Wednesday, Thursday, Friday. Now you should be able to go right to your trading partner, look on the bottom, see all the positions you have, look in your balance line column, see where your stop is, and you should feel comfortable. That's it. Your work is done. You now have your orders ready for Monday, which really we don't have any orders for Monday except for placing our stop in the market. So hopefully this has helped you in learning how to fill out your trading partner, and we want you to understand how important having good organizational skills are in this business. If you don't have them, you can have a really costly lesson, and we'd prefer that that didn't happen to you. So have a great weekend. Make sure you keep up with your morning pages, your date with your IT, looking over your videos, your computoral, and we'll look forward to seeing you on Monday.